In section 2, we're going to discuss market structure and technical tools. So what is our objective? We want to learn how to identify major price cycles. We want to learn how to identify support and resistance zones. We want to learn how to draw Fibonacci retracements and projections. We want to learn how to draw trend lines and channels. And we want to learn how to find high probability trading levels. So let's have a look at price cycles, major versus minor cycles. And in this example, we're going to use an upswing. So first things first, what you want to do is identify the lowest low and the highest high. Take note that I've made a note of a daily or 4-hour chart over here. This is very, very important. Higher time frames carry the most weight. These are our major swing points. If we follow price through the minor cycles, you can see we have a swing high, followed by a higher swing low, followed by a higher swing high, followed by a higher swing low. These are our minor swing points on the bottom, and these are our minor swing points on the top. So just to recap, we have our major swing points from the very low to the very high in an up move, and our minor swing points, the lowest lows and the sort of intermediate highs for our minor swing points on the upside. If we have a look at price cycles now, major versus minor in a downswing example, once again we identify our highest high and lowest low. These are our major swing points. And if we follow price down, you can see we have a swing low, a swing high, a lower swing low. These are our minor swing points. And a lower swing high. And you can see on the top side, these are our minor swing points. So recap, identify your major swing from the highest high to the lowest low, and then you can identify the minor swing points in between these cycles. But the important thing to note is where the highest high and the lowest low are in a downtrend. And these are very important. We're going to discuss why shortly. Hi traders, I just wanted to give you an example of major and minor price swings. This is a pound-dollar daily chart that we've got here, and if we just identify our levels, our swings from the very low to the very high, and from the very high to the very low, you can see these are our major swings that we're dealing with, as in the example. And if we highlight those, there's the top point, there's the bottom point, and the same on the downswing. There's the high and there's the low. And it's very important to identify these. It's really, really simple, because when it comes to finding or using Fibonacci levels later on in this section, and the horizontal support resistance and trend line section, we know where we can expect key areas before price gets them. Okay, so really simple, from the very low to the very high. When price is moving up and then it starts to retrace, we want to pay close attention to this swing here. And when price is moving down and it starts to retrace, we want to pay the most attention to this downswing here. Okay, so very, very important. Once again, when price is moving up and it starts to retrace, we want to pay the most attention to this leg up. And when price is dropping down and starting to retrace, we want to pay the most attention to this leg here. Same when price is moving to the upside here and price starts to retrace, we want to pay the most attention to this swing up. Hope you found that helpful. Let's now look at order flow and what goes on at and around a key level. So we have a key level in the marketplace, and around that key level we have a stack of orders. Okay, now we have sell orders below the level, at the level, and just above the level, and then we have buy orders stacked above the level. So essentially what's happening here is if price is approaching from the bottom, okay, and it's approaching a key area of resistance for the first time, especially if this area hasn't been seen for a while, you have a lot of orders stacked around at different zones. Okay, remember, institutional traders are trading massive size. They can't just click sell or buy and put their whole position into the market at once, just because there's not enough orders at that area. Okay, so we'll discuss something called accumulation of orders shortly, but just understand that they're not like us sitting at home where they can just click buy or sell and all their positions get filled, okay, at one price. So essentially you have orders stacked up around key areas, and the longer prices stayed away from an area, a key area that is, the more orders you're going to find stacked up. Okay, so just understand sort of the essential characteristics of how these orders are stacked. So you've got your sell orders stacked around this area, and then you're going to have your buy orders. Now your buy orders are going to be made up from your stops, okay, your stop loss. So if you're selling around a key area of resistance, for example, you're putting a stop loss sort of just above that key area, right? Now essentially a stop loss is a buy order. Okay, so if you're selling, you need to buy back the position or close the position by buying. Okay, so essentially it's a buy order, right? You've also got buy orders in terms of breakout traders above the level. All right, so that's going to have implications or an effect in the marketplace, that if price moves past a certain area of the resistance level, then that's going to push price higher. Okay, so let's see what happens when price sort of approaches these areas. So you have price approaching a level, and you have sell orders hit. Okay, once those sell orders get hit or come into the marketplace, here again I'm talking about limit orders more than orders that are actually resting in the marketplace here, because you never know what's going to happen in terms of people actually hitting market orders. They're going to come in at any time they feel like. This is really around limit orders. So you have price come up to a level and hits those sort of first block of orders, and what happens is price fades. Then you'll have price come back up into that area, and you can see now we've actually hit the key level, and you have more sell orders coming into the market or getting hit, and you'll see price fade again. And then if the orders are not big enough, okay, you may have price have up sort of a third or fourth time into that area, once again just picking up more orders. And this is sort of an accumulation of a position. Remember, the large institutional traders, they'll come in, as I said, not at one specific level. They'll try and stack orders at different levels like this, or put them in sort of bunches, okay, so that they don't drive the market down. If they had just had one big stack of orders at one level and they push sell, what's going to happen is price is going to drop off, okay, take out orders below, and if they want to add further positions, they're going to have a worse fill. So in order for them to get the best possible fill on their position, they will drive price up, okay, and you can see what happens. Okay, obviously we've got a larger picture here, but what happens around these highs? Okay, the same thing, essentially what I've drawn in the larger picture. You're going to have stop orders. Okay, so if you sold in here, for example, you're going to have stop orders and buy stops, okay, around this level. And that's essentially what the institutional order flow, what the institutional traders are looking for. They're looking for essentially retail stops. Okay, so remember, if you're selling around here, you're going to put a stop loss above the high. Same thing here. If you're selling in around this area, you're putting a stop loss over here. And that's essentially, what the professional traders are looking at. They're asking themselves, where are the stops placed? Okay, they need the stops, okay, for liquidity, all right, because they want the best possible price. So just think about it in terms of, we want the best possible price, okay, and in order to get that, we need to go where the liquidity is in the marketplace, and essentially that's where all your stops are going to be sitting. So above these highs. So once you've got this accumulation going on and they're building up a position, once again, stops, break it, buy stops, okay, sitting above these areas, price will fade, right? So once that essentially happens, you can see we're actually sort of filling at different areas here, and you'll very often see this will kind of form like a wedge kind of pattern, okay, which is quite a high probability pattern. I haven't gone over those patterns in this course, but if you've traded wedges before, you'll very often see that sort of effect. The same as with your 3 drives pattern, okay, also a harmonic pattern. That's essentially what it is. It's picking up orders or accumulating orders at different levels, okay, and that's essentially forms your support zone, okay. Remember, we talk about zones and not particular levels. That's essentially why, because we've got price driving in at different areas, okay, accumulating positions, and that's really why we're marking off zones and not specific numbers. When price drives higher, okay, remember these orders here, okay, once they get taken in, there's very few sell orders. So eventually when price comes back up to that area, there's not many sell orders left. And essentially what's going to happen is you have these stops here, okay, so if you accumulate stops, sell orders, sorry, positions here, and price breaks through a certain level, that's going to trigger stops. Now essentially your stop, okay, if you're selling, is a buy order. So you have your buy orders in terms of stops, as well as your breakout traders, okay, stacked above the level. And once that gets hit, you're going to have price push, okay, a lot higher. All right, now, if there's not enough orders there, or enough interest to push price or continue with a strong uptrend, what's going to happen is price is likely to come back, okay, to this area. So what actually happens around this level right here, okay, if we think about it in terms of order flow, we have, once again, we have buy orders, okay, stacked up from fresh buyers, okay. We have buy orders from previous sellers. So remember, if you accumulated short positions here, if you didn't put a stop loss in here, okay, when price breaks above and it comes back, okay, you're essentially buying, okay, you're clicking buy to get rid of this position. So there again, you've got buy orders from those sell orders here, and then you've got buy orders, okay, from newer sellers taking profit. So if there was a key area of resistance up here, for example, and we had sellers coming to the market, they need to buy back that position. So once again, you've got accumulation of buy orders at this area here. So essentially that causes that resistance becoming support, that price flip we spoke about, okay, and you got a high probability of price moving off that area. So that's essentially the essence of order flow, and how the institutions come in around these levels and how they use those levels, and that essentially forms these key areas of support and resistance. Okay, so remember, they are zones and not specific numbers. Key support zones. Let's discuss the double and triple bottom. Here again, please note, I've made a note of a daily or 4-hour chart example. This is not a 5-minute chart or a 15-minute chart. We find these patterns on a daily and 4-hour chart. Very, very important. In this example, we have price drive down. You can see we have good buying pressure or a bounce. Once we identify that bounce, we can draw a horizontal line off the lows. And what we're looking for is when price returns, if it returns back to this area, we're looking for a bullish reversal pattern to buy at this level. So this is your double bottom, and we're looking for price to rally, showing some decent buying pressure. You can see a new high is made right here. This high is taken out. Price then drives lower again, and once again it's at this level that we're looking for a bullish reversal pattern to buy. Once again, new buying pressure comes in and we take out the highs. This is the key resistance zones. This is the double, triple top, so it's just the inverse of what we just discussed. Price rallies. You can see we get some nice selling pressure coming off a level. We identify the highs as a potential resistance zone, and when price gets back up to this level, we look for a bearish reversal pattern to sell short. You can see here we have offers coming into the market. The market makes a new low. See this low right here gets taken out. It's an indication that we could see a nice move to the downside at some stage. Price then rallies back up and it fills the orders waiting at the level. Here again, we're looking for a pattern at this level, which we'll get to in the next section. And you can see price drives lower once more offers come into the market, making new lows. Let's look at the next type of support resistance, where key resistance becomes key support. I call it a price flip. And in this example, we have price drive into a key resistance area, as previously discussed in the double and triple top. Price rejects nicely. Get some good selling pressure, new lows seen. Price then drives back up to the level, and it's at this area that we could look for a bearish reversal pattern. You may get a decent little bounce off the level. Here you can see offers are drying up and higher lows are seen. So in the previous example, these lows were taken out when price drove off the level. In this example, and here again, there's no certainty in the marketplace, but these are telltale signs that we could possibly see a drive higher. So once again, if price gets up to our level, I'm going to look for a reversal pattern, but be wary of the higher low made. In this example, price drives through the level, no pattern seen, or if there was a pattern seen there, the pattern failed, and we're looking for a retest now. So you can see price is making higher highs, higher lows. It's driven through our key resistance zone. You can see the sell orders are taken out and no more offers are left. And when price comes back to our area, we're looking for a bullish reversal pattern at our key support zone. So once price was up here, it was at key resistance, came into the level, sold off nicely. It rallied up to the level. We had a nice rejection. Here again, these lows were not taken out. Telltale sign that we could very well be moving higher. The third attempt now, you can see there's no more selling orders left. Price drives through. And now on the return, resistance becomes support. And at this level, we look for a bullish reversal pattern. Here again, good buying pressure seen, and the market is well bid to new highs. On the opposite side of this, key support zone becomes key resistance zone. Here again, also a price flip. We have price come down to a key level, it bounces. We get some good buying pressure off the level. On the return to the level, we look for a potential bullish reversal pattern, as the example showed with the double and triple bottom. Price drives off the level. Here we see weaker buying pressure because a lower high is made. So very important to watch your previous highs and lows. In this example, the high is not taken out. It could be an indication that we may be heading lower. In this instance, we look for a buy opportunity or a bullish reversal pattern. Once again, if price comes down there, remember these are daily and 4-hour levels. These are not 5-minute and 15-minute levels. These are big levels that the institutions are watching. You could still find a trading opportunity around here on a day trade or a scalp for 20, 30, maybe 50 points. This instant price drives through the level. You can see no more bids, order block taken out, as the example showed in the one of these slides that I went over on what happens around these levels. On the return back up to our area, we want to now look for a possible bearish reversal pattern. So key support zone gets taken out. We now look at this as a key reversal or key resistance zone, and we look for reversal patterns to the downside. And here you can see we have good selling pressure coming off our level of interest. Alright traders, I just want to show you an example of the double bottom, double top and the price flip. So in this example, this is a 4-hour Aussie dollar chart, and you can see prices ticking along nicely here. These are 4-hour candles using a great piece of software called Forex Tester. Great to test strategies as well as practice on levels, fibs, trend lines, etc. So you can see in this example we've got a swing low point when price came down to this area previously. We had a very nice reaction from this area, and then prices come back down and sort of just sat around that level. So this is an area that I'll be interested to look for a pattern on a smaller time frame. So we mark this level off, and here again, what's nice about this way of trading is we mark these levels off beforehand. Price comes back to this area, I'll be interested to see if we can find a trading opportunity. You can see we get a very nice reaction. Now you don't have to put an order at this level because we just don't know if the level will hold or not. So if we go down to our smaller time frames, which I'm not going to do in this example, I just want to show you how we go about finding these levels. Okay, very, very important how we find these levels of interest. So that's essentially the double bottom. Pretty straightforward. We can then look at areas of key resistance for double or triple tops. Now you see this level up here, we had price come up to it previously, hit the level and reject it. So this could be an area where we would look at a possible triple top. So once again, we could mark this level off. If price gets up to that area, we could look for a pattern on the short time frame to sell. So we'll just follow price along. You can see a very nice move up. Now here again, you don't have to just sell into the level. We can look for patterns on the smaller time frame, but if we get reaction or a pattern around this level, we're keen to look for a sell. And you can see price sort of stalling out here again. Remember, these are zones, they're not specific numbers, so we can work with a few pips either way. You can see price starts to break to the downside off that area. So again, nice area of resistance. That's your double top, double bottom. And in terms of price flips, here again, you can go and practice this a little bit, but you see this area here and resistance, a breakthrough back to resistance. This could be an area here that we may be interested in a possible buying opportunity, also known as a price flip, where we have resistance becoming support or support becoming resistance. So we can mark these levels off and just wait to see what happens around these areas. Let's see if price gets down to that level. So we're breaking down. Okay, so there's the reaction of that area. Here again, you could look for a pattern on a smaller time frame to see if anything's happening around there. And here again, you can see this area. This is really your resistance becoming support type price flip. And you see up here again, you have area of support maybe becoming resistance. So if you've got a pattern around there, you could look for a sell. You can see here again, this is a 4-hour chart, big moves off these levels, so you could look for patterns around these areas. So I hope that's been helpful in finding your key levels: double bottom, double top, and then your price flip where resistance becomes support and support becomes resistance. Let's have a look at how to use candles and bars in your trading. Here again, I haven't gone over certain candle patterns or bar patterns in this course because I don't feel they're relevant. They're very retail. Institutional traders are not looking at a hammer or a bearish engulfing candle and saying, you know, let's go short or long because of this. The way they look at candles and bar patterns is really about commitment, okay? So what you're doing is you're identifying your key areas of support and resistance, or your zones, as we've gone over. And what you're looking for, and this is here again, you know, this is very important to focus on your higher time frame. So daily and 4 hour are my main time frames that I look at this on, but hourly also very, very important. The smaller time frames, although they can act in decision making, they're prone to not be as accurate. Okay, so here again, if you find these sort of occurrences on a daily or 4 hour chart, it can really add a lot of weight. Here again, key areas of resistance or support, and what you're looking for is price to actually commit, okay, and close. So you're looking for big candles to close below key levels, and this really just shows commitment from the larger flow. So here again, you know, you want to have a key area of support or resistance identified, and once price actually commits and closes, and here again, you want to see a decent size candle, all right? You don't want to see it just close very briefly below or just above a level. You want to actually see it take out. You see these wicks, for example, here. You want to see it clear and close. The important thing is it must close below these areas, and the closer it closes to the lows, the more weight it adds. Okay, it just shows institutional flows coming into the marketplace, and it can be a good sign that you're going to be heading lower. Okay, so we just follow price along here, come up to an area of potential resistance. Okay, here we can highlight it. And you're looking at, remember, we're looking for patterns around these areas, and if we're going to break through back up into this area, remember we've now hit this level a good few times, so you know it's not as important as it was when it sort of first comes to the level. Remember, talk about order flow and how price sort of eats into the level, eats up those orders. So once again, you know, you can still look for possible patterns around here, but you're really looking for, you know, when you come up to an area after so many times, and sort of a gradual approach, you're looking for that breakout. And once again, okay, what I'm looking for is looking for big candles, and I'm looking for the close. The close is very, very important. Okay, so once you get close and you show commitment from the larger flows above that level, okay, it's very, very key. Here again, watch these wicks and the previous candle bodies. You want this candle here to close way above them, okay, just to show that commitment, okay, because if it just closes right above, you know, just a short distance above, it's very prone to get sort of a false break where, you know, essentially what's happened when it sort of just closes above and then moves straight back in, okay, that's a false break, and it's just really a liquidity hunt, okay. So institutional traders will push price just above the level because they know the stops are going to be sitting at that area, okay, so they can grab those stops, get a better fall for their larger positions and push it down again. So just be aware of that. This indication here and here is what you want to look for, okay. Finding key support and resistance zones. Remember, we're looking for these zones or levels on daily and 4 hour charts. So how do we go about finding these levels? Let's follow price and see what we're looking for on specific areas. So if you follow price along, you can see we just up, down, up, down, up, down, just complete randomness. But if we start dissecting price, meaning that we look for certain patterns or levels, we can start making more sense. Here again, look at the wicks and the bodies. And if we start putting some horizontal lines across on our chart, you can see it starts to make a lot more sense. Here in this example we have a double bottom in place, and here again, remember, we're looking at wicks and bodies. And then on the top we have a double top in place, and then eventually a triple top, and then price breaks through and it comes back and gives us a price flip. So we're looking for multiple rejections at a level. 3 or more visits to an area adds more weight to the level. We also want to watch the candle wicks and how price leaves an area. So let's talk a little bit about refining support and resistance levels or zones. What you want to look for is you want to see how price leaves an area. Was it a slow, sluggish move away or an aggressive move away? Also, what you want to pay attention to is where you have price leaving a level and the last candle before it leaves the level. So here again, reference the last bearish candle in this up leg before price started to rally, when price approaches that area again. So you can see price was in an uptrend, consolidated very briefly, and then it took a nice break out of the level and then never came back. Here again, same situation here. We dropped nicely away from this area, and you can see price is now coming back down to this level. So this candle right here is what you want to pay close attention to. Here again, how did price leave this area? Was it a slow, sluggish move away or a more aggressive move, like here, here, and here? We note this area here as resistance, and here again you want to pay close attention to this last bullish candle before price broke away. So we reference the last bullish candle before price started to drop, when price approaches the highs again. And it's at this level right here we're looking for a bearish pattern. Once again, you see how price broke away from the lows. We reference the last bearish candle before price broke away. And once again, we're looking for a bullish pattern when price gets back to that area. Now, you may very well find a pattern in this actual swing, maybe a bat pattern or a Gartley pattern or another pattern that you identify with. We haven't discussed patterns yet, but when we get there, hopefully it'll make more sense to you. And once again, you're looking for price to reject from this level. So recap, look for price to move away from an area aggressively. In this case, we had a nice uptrend. Price consolidated very briefly, then took a nice breakout, continued its upward move, it then broke away aggressively. And you want to reference, in an uptrend, you want to reference the last bearish candle before price broke out, and in a downtrend you want to reference the last bullish candle where price broke out aggressively. And you can see when price comes back to this area, we get a reaction, and when price comes back up to the resistance area where price broke away aggressively, we get a reaction. And the same down here where price broke away aggressively, we get a reaction. Okay, these are order blocks in the market where orders stack up, as I showed you in our example of what happens around these levels, and we'll show you a live example shortly. Hi traders, just going to do a quick video on how we can go about refining our support resistance levels. This is a 4-hour chart of the Australian US dollar, and here again, just keep it really simple as I showed you in the slide. Look at the last bullish candle. So you see this move up, then price breaks away from the area, reference the last bullish candle where price breaks to the downside, and then if we look at this last leg up, then reference the last bearish candle where price before price breaks out. So there's a little bearish candle there, you see how price breaks to the upside, and there's another bearish candle down there that we can also mark off and see if price gets down to that level. Here again, we're just refining these levels, not necessarily want to make a trade at the level just on a limit order, but we may want to fine tune it and look for a pattern around the level. So we just here again fine tuning those higher time frame levels. So we'll just follow price along. Where you can see we get a little reaction off that, so maybe there's a pattern over that in that area. You see the reaction that you can get off these levels just by fine tuning these levels a little bit. Follow price through. You can see a massive move down now, and look at the reaction we get off that little level there. Okay, nice little move off, and here again comes back, references this last bullish candle here before price takes a leg down. Look at the little reaction we get off that area. Okay, so I hope you found that helpful. Just one of the things I look for when I'm looking at key levels of support and resistance. Let's have a look at Fibonacci retracements. In this example, I'm going to use an upswing, and please note, as always, we're using the higher time frame, so daily and 4-hour chart. And I've noted here, always look at the lowest low and highest high when drawing Fibonacci levels. So we identify our swing from the very low to the very high, and you can see we've marked them off as in our example with price cycles. We have major swing points. Okay, you can see we also have minor swings here, but we want to leave those alone. We want to make sure we're paying attention to the most recent leg up, as well as the major points, the major low to the major high. It's what the institutions are watching, and it's what you should watch as well. And all we do is we just draw our fibs from the low to the high, and again, these are the retracement levels: 38%, 50%, 62. The 70.7 is a not very well known fib level, fib retracement level, but it works exceptionally well on the higher time frames. The 79 level, 78.6, and then the 88.6 is the deep fib retracement. There again, also not that very well known, but works very, very well. So let's have a look now at Fibonacci retracements in a downswing. Once again, please note daily and 4-hour chart, and we always look at the highest high and lowest low when drawing Fibonacci levels. So you have a price swing, we identify the highest high and the lowest low, and you can see here again we have major swing points. So although we have minor swing points as well, we want our fibs to be drawn from the major highs to the major lows. So keep it really simple, and remember, the big swings are what institutions are watching. And here again, just straightforward, draw fibs from the high to the low: 38, 50, 62, 70.7, the 79 or 786, the 886, and then 100%. So just straightforward Fibonacci retracements. Hi traders, I just want to go over how we draw Fibonacci retracements. This is a Euro-Dollar 4-hour chart, and this is in a live environment. And what we're going to do is we just want to identify our swing points. So we've got a swing low up to a swing high, and a swing high down to a swing low. So those are the two major swings that we're dealing with at the moment. One there and one there. The reason we're not using this swing for the time being is that we've already retraced. If we draw your fibs from this swing high down to this low, you can see we've already retraced past the 79 and just shy of the 60, or paper on the 886. If this high gets taken out here, if price surges up and takes this high out, I'll then look to this 886 fib. But for now, this is the most recent swing up and swing down that we're dealing with. We've also obviously got this swing here, but for now we'll just use these two. So we'll draw our fibs from the low up to the high. Okay, don't worry about all these minor swings as we went over in the price cycles. We identify the major low, major high. We draw a Fibonacci tool from the low up to the high. You can see prices retraced to the 38, 50, 62, 70.7, just shy of the 79, and then taking a leg up. And then we've got this leg down. Same thing. If we take our fib tool, we draw it from the very high to the very low. And you can see in this instance, prices surged through the 38, through the 50, stalled briefly at the 618, through the 70.7, stalled the 79 retracement. And now he's starting to move down. And if you do the same thing again, we look at this leg up. Now you start to look at more the minor swings from the low up to the high, and you can see we retrace to the 38% retracement at the moment. Hope you found that helpful. Let's have a look now at Fibonacci projections, or extensions as some people call them, in an upswing. Pretty straightforward. We identify a swing from a high to a low, or in this case a low to a high. And you can see how we've just drawn the retracements. Okay, so we identify the major swing, draw the fibs from the low to the high, and you can see we've labeled this XA. We're going to start labeling our swings, as in the case with some of the patterns which we'll be getting to in the next section. Pricing comes down to one of our levels and then bounces. You can see it bounces at the 50 and then it drops lower to the 62. These are Fibonacci retracement levels. We then have price drive higher, and you can see it comes right up to that 127 projection or extension. So price breaks the 0%. Okay, so remember, from X to A, we have the 100% here and the 0%. Price comes down, retraces, finally finds support at the 62, and then it rallies. It takes out the highs at A, or the 0% level, into the 127 extension. So that's your fib projection. In the next example, we have the same situation where we have a upswing X to A, and you can see the retracements drawn from the X to A point: 38, 50, 62, 70.7, 79, 886, 100%. Price drops. You can see this is your fib retracement, like we went through in the previous section. We get a reaction, and then price continues down. Okay, so this time you see how it breaks the 100%, but it comes down into the 127 extension. So you've got the extensions above and below, one above the 0% and one below the 100%. And that is your Fibonacci projection or extension. Let's have a look now at Fibonacci projections in a downswing. We have a move to the downside labeled X to A. We then draw our Fibonacci tool from the high to the low. And you can see in this case we get a retracement up to the 61.8%. That's your fib retracement. Price then drives lower, and you can see in this case it breaks through the 0% level, so it takes out the lows at point A, comes right down to the fib projection at the 127 extension, and you can see price reacts. On the opposite end, we have the same swing from high to the low, labeled X to A. Price then retraces to the 62% fib level. We get a reaction down, but in this instance you can see price, instead of breaking the lows at A, it now turns and continues taking out the point at X. So it actually takes out the 100% fib level. And it runs up, in this case, to the 1618 fib projection. And you can see we get a nice reaction off the level. So just a recap, on the downswing we draw our fibs from the very high to the very low. Price retraces, and it can retrace to any of the retracements. The minimum is a 38% fib level, but it can retrace all the way up to the 886 or even close to the 100%, and then come all the way back down, breaking the lows at A. And you can see it runs down to the Fibonacci projection, and there are different levels that we are going to concern ourselves with. The two most commonly known numbers are the 127 and the 1618, but I will show you a few others a bit later on in the section. And then the opposite, price drops in the same instance, X to A, it retraces to the 62% fib level. Here again, it can retrace to any number in the fib retracement sequence, and then retraces back down. It doesn't take point A out, and then rallies hard, taking out point X. See, it breaks through the 100%, and this time in this illustration it runs up to the 1618 extension and rejects. Hi traders, just a quick video on Fibonacci projections or extensions. Here again, keep it really simple. Identify your swings in the marketplace. If we look at this swing up from the low to the high, this is a 4-hour chart of the Aussie dollar. Here again, look at your higher time frame swings over your smaller time frame swings when identifying levels, and you can see here we have a 127 extension or projection and a 1618 projection or extension, as well as a 127 and a 1618 on the top side. So we follow price along. You can see we get a spike down into the 127, and we get a nice reaction. Here again, remember, we're not using these in isolation, we're using them with other tools. Now if we just follow price through, and let's just clear the price chart up. If we now have a look at this swing down, you can see we've rallied 38, 50, 618, 79, and if we also look at this swing up from the low up to the high, you can see we retrace to the 38%. So we've got a few levels to watch. You can either look at these areas down here, or we can look at these areas to the top side. So if we follow price along, you can see we retrace to the 50, start to rally. So there's the 127. That one gets a little bit of a bounce, continues its up leg, and you can see how we've broken the 0% over here. So we rallied, retraced to the 50, then we break the 0%. On this one, we've retraced all the way to the 79, dropped down, and now you can see we've broken the 100%. So those are the two types of projections. The one breaks the 0%, the one breaks the 100%. You can see how we've drawn the fib tool on. So the ones from the high down to the low, and then the other tool is from the low up to the high, and those are the two extensions. 127 is a bit of a bounce, and the 1618 turns price nicely. So here again, remember, we're not using these in isolation, but I just wanted to show you the two different types of projection or extensions and how we draw them. Hope you found that helpful. Let's have a look at combining Fibonacci retracements with Fibonacci projections now. So we label a nice swing XA, and we draw a retracement tool on it, or a Fibonacci tool on it. Here again, from the low to the high. We're now looking for price to retrace. Here you can see we get a retracement down to the 618 or 62% fib level, and we label that point B, and you can see we get a bit of a reaction. Now what we want to do is we want to draw a fib tool from point A to point B. Okay, so in the first instance we had a nice rally and we drew our fib tool from point X to point A. We were then looking for a retracement. You can see price broke through the 38, through the 50, and it found support at the 62 level. It then bounced, and what we did then is drew our fib from a new fib, that is from A to B, and you can see prices starting to rally, breaks through the 38%, through the 50, slightly through the 618, and you can see we start to stall. Now you can see once we've got these two fib tools on, the retracement tool on both swings, from the XA swing and the AB swing, you'll see the XA swing retracement, which is the 786, lines up with the AB swing with the 127 projection or extension. And you can also see further down we have a 1618 extension with a 2618 extension or projection. So there are two potential areas that we could look to take a trade from: 786 or 79 retracement and the 127 projection, and then further down there's a 1618 projection and the 2618 projection. Now these are actually two potential patterns that we'll be going over in the next section. The one is the Gartley, which is this retracement and projection, 79 and 127 projection or extension lining up. You see the same numbers here. Or the crab pattern, which is a very deep extension pattern. Price retraces to the 62% retracement and then it gets a drive down. But we'll go into that in further detail in the next section. In this case, you see we get a nice reaction off the 79 and 127 projection. Hi traders, I just want to go over how we combine Fibonacci retracements and Fibonacci projections. Here again, this is a simulated chart of the Australian US dollar. This is a 4-hour chart, so remember, higher time frames are always the most important. And first things first, we want to identify our major swings. So if we look at this swing down, from the high down to the low, if we draw our Fibonacci retracement on that swing, you can see we have a 38, 50 where prices bounced, 62, 79, 886. We also want to look for our Fibonacci extensions or projections. So if we look at this swing up, from the low up to the high, you can see we start to retrace, and then we've broken the high. And if we draw our tool on that swing up, you can see we retrace down just shy of the 62. Now we start to rally. Now have a look at the 886 and the 1618. If you see, the confluence of the two is very close together. We also have a area of horizontal support and resistance here. You can see we have in here support, resistance, support, support, resistance, support, resistance. So we have very nice confluence there. This is actually one of the patterns that we look for in the course, which we'll discuss in the next section on patterns. But I just want to show you how we use confluence of the retracements with the projections. And if we follow price along, you can see we hit the 1618 with the confluence of the 886, and we get a very nice reaction to the downside. Hope you found that helpful. Let's have a look now at trend lines and channels, and once again please note daily and 4-hour chart. Okay, not 5-minute or 15-minute, daily and 4-hour. It's all about the higher time frame key areas. Okay, remember, we're not moving the market ourselves, so we need to rely on the institutional traders to move the market for us. So all we can do is find the areas that they are likely to be watching and trade around those levels. So let's have a look at what we're talking about when we talk about channels and trend lines. First things first, we want to identify two swing lows and two swing highs. Okay, really straightforward. And you can see I've labeled them, two at the bottom, two at the top. We then want to connect the lows and the highs, and you can see it forms a channel. Right, now this is obviously a picture perfect example, but you'll be amazed at how well the market keeps to these channels in a well-defined trending environment. Here again, you can see between point 1 and 2 we have a price flip. So we have resistance, now comes back to support. And when price comes back up to the top end of the channel, we may want to look at establishing a short trade. Once again, you can see price breaks the top at resistance and it comes back down to this level. So we have the channel and the horizontal support or resistance becoming support. You can also add in some Fibonacci levels, which we'll get to a bit later on. And you can see price rallies up to the top end of the channel, drives back down. Once again, resistance likely come back to support. And look at the channel, how the channel holds. So it's at these levels here that we're looking for potential sell opportunities, or in this instance a buy opportunity, and the same over here. Then price breaks down, and watch this very closely. When price breaks these lows, we have resistance becoming support, and it cracks this trend line. Pay very close attention for a short opportunity. So once again, we're looking for patterns to sell if these trend lines or channels align with other areas or zones of resistance. And we're looking for patterns to buy if the trend lines or the channel at the bottom of the channel lines up with other areas of support. So in this instance, you see how we had this area of support, horizontal support, and the low area of the channel line or the trend line lining up gives us a nice confluence. And the same here, once again, we have resistance, it breaks, it comes back, we find confluence with the channel line as well as the horizontal support line. You can see price breaks through and it comes back to retest the back end of the channel line or the trend line, and we look to sell if these trend lines align with other areas of resistance. And here again, which we're going to discuss in the next part, we're not going to just click buy, sell, sell, buy, sell. We're going to look to see if price confirms that our analysis is correct and that there's somebody willing to step in at these levels and push price in our desired direction. Let's talk about putting it all together and the power of confluence. We are looking for key support and resistance zones to align with Fibonacci retracements, Fibonacci projections, and trend lines. When we have more than one tool lining up at the same place, it stacks the probabilities in our favor. No trade will be considered if a key support or resistance zone from the daily or 4-hour chart is not present. All confluence levels are found on the daily and 4-hour charts. Please read that again. All confluence levels are found on the daily and 4-hour charts, not a 5 or 15-minute chart. The main players in this industry are trading off a big time frame, your daily, weekly, monthly, 4-hour chart, not a 5-minute chart. Please be very careful about trying to trade smaller time frames like 5-minute charts without taking note of the bigger picture. So let's have a look at a little exercise I've put together. Identify key confluence levels on your daily and 4-hour chart using the above tools. What you're going to do is highlight the areas on your chart and then journal each reaction price has from those levels. Take notes of the maximum drawdown as well as the maximum reaction from the level before price comes back to the level. This will build confidence in your analysis. The more you do it, the better you will become. Finding high probability trading levels, combining Fibonacci retracements with key support and resistance zones. In this example, we're going to use an upswing or an uptrend. Here again, please note we're looking at a daily or 4-hour chart, and importantly, we're looking at the lowest low and the highest high when drawing Fibonacci levels. Very, very important. We're not looking at small levels or small swings. We're looking at the major swings on the daily and 4-hour chart. So first things first, let's identify the swing, lowest low, highest high. These are our major swing points as discussed in the first section on cycles. We draw a Fibonacci from the low to the high, and you can see the retracement 38, 50, 62, 70.7, 79, 886 and the 100%. We then add in our trend lines, so we find 2 swing lows or highs. If we've got channels, we can draw those in as well, and we extend the line out. We then note key resistance zones. So as you can see on the left hand side, we've got key resistance noted by this red arrow. We then have a key support zone right here. You can see price came back, held support and then rallied. That's noted by the green arrow. If we now run a line, a horizontal line between the resistance and the support, you can see we have a price flip where resistance broke through, became support. What else do we have? Well, if we look closely, we have confluence of a 38% retracement with a horizontal support and resistance level. There's your 38 and your support zone. We also have a key resistance zone across here. So if we mark that off with a horizontal area, here again, note these are zones. Okay, that's why I've got 2 lines and not 1 line. You can see we have confluence with the 50% fib retracement, the key support zone, and the up-sloping trend line. Where else do we potentially have a level that we may be interested in? Well, if we look down towards the lows, we have a resistance zone and a support zone. What does that line up with? Well, if we put a horizontal line across there, you can see we have a nice price flip, 70.7 with a key support zone. So these are all levels that we could be interested in placing a trade. What we're looking for now are bullish reversal patterns on a smaller time frame at these levels. So please note that we're not looking for patterns on the smaller time frames and then seeing if there's a level around us. We're looking for levels on the daily or 4-hour chart, and then we're looking for patterns on the smaller time frame. You can see price comes down, it breaks through the 38% level. So although this was good confluence, there were no buyers available. Okay, now there may have been a smaller time frame pattern on a 5 or 15 minute chart that failed. We wouldn't know looking at a larger time frame like this. That's why we use the top down approach. Price then comes down to a next level, and it's at this area right here that we're looking to find a bullish reversal pattern on the smaller time frames. Price rallies into a potential area of resistance. Look at this level right here. We have a key resistance zone, becomes support, and it's at this level here we could possibly find a bearish pattern. So if we draw our fibs from this swing high down to this low, we may have confluence with this area of horizontal support resistance. Now I haven't put the fib level in there because it may look a little bit on the messy side, but you can see I've noted it as a key resistance zone. In this instance, price drives deeper, takes out the 62 and then goes into the 70.7 level. Here again, we've marked these levels off beforehand. These are not levels that we mark off as price is reaching them. Okay, so we can be relaxed and prepared. We can even set alarms or have a text sent to your cell phone or your mobile, and you can get ready to place potential trades or look for potential trade opportunities around these levels. And you can see we get a nice reaction off that area. Once again, we're looking for patterns at these levels. We're not just clicking buy, buy, buy. Okay, you can do that, but that's not the way I want to teach it. We're going to look for patterns to confirm that these areas are likely to hold and give us a very high probability trading opportunity on the smaller time frame. And here again, you can see I've noted this area right here as potential resistance. So once again, resistance becomes support. We get a bounce. Now, even this small bounce on an intraday chart or as a day trade could be a few hundred pips. So that's why I say the higher the time frame, the more power it has, as the larger institutions are paying close attention to these levels. I hope you found that very helpful. In our next section, section 3, we're going to be looking at the different patterns that we look to identify at these different trading levels. So I suggest you review this on how we find the levels. We've discussed the price swings, we've discussed the Fibonacci retracements and the Fibonacci rejections with the trend lines. Now we've added them all together, and this is what we do on a daily basis to find high probability reversal levels. And all we have to do is now wait for a smaller time frame pattern to set up at this key area where we can place a high probability trade. Hi traders, in this video we're going to go over finding trading levels using confluence of Fibonacci retracements, Fibonacci projections and horizontal support and resistance, as I discussed in the section. So here again, putting it all together, if we identify the major swings in the market from the very low to the very high, let's draw our retracement tool on that, swing up, and you can see we retrace down to the 38% fib level here, and then we rally. Now once we start to rally, we can then look for potential projections to the downside. So you can see we've hit the 38, so we could find something possibly at the 50, 618, 79, 886. So let's see if we can find some confluence. If we look at this swing down and we draw our fib tool on that, from the high to the low, we have standing out the 50 retracement with the 127 projection, as well as the 618 and the 1618 level. Now if we have a look at these areas here, you can see we have horizontal support resistance around this area as well. You can see we get some good price action around here. Nice level of resistance. Price breaks out of this quite aggressively, so we have a bit of confidence there. But if we have a look further down, you can see we have this level in here that looks really interesting. See how we have price break away like this, and we also have a nice level of support and resistance across here. So that's also very, very interesting. Remember, we also went over refining our support resistance level. So if we have a look at this level right here, see the last bearish candle before price breaks away. Paying close attention to that. See how it comes into our confluence area of the 618, 1618 and horizontal support resistance, so we can actually fine tune the level right down into this area here. Okay, so if we just compress the chart once again, if we mark this little block off there, that's something I want to definitely pay attention to. You can see further up we've got another level there as well as there. See, prices come down, hit this level here and reacted very nicely. So we've got this level here, but we don't have any confluence, and this level here. So here again, not a bad level around the 50. And remember, we're looking for patterns at this level. This is a higher time frame level. So in terms of stop placement, if you're going to trade the larger time frames like this, you'll always need a bigger stop. So if we follow price down, you can see price spikes through this area here. Okay, so we may have found a pattern on the smaller time frame, and we get a bit of a bounce off this area. So once again, identifying those key areas of confluence on the higher time frame. We follow price along here. You can see price now breaks the low, and we now have price approaching this key area right here that we're interested in. So price comes down, spikes into the level. Look at the area. If we just move this horizontal level across to the last bearish candle right there, you can see how price reacts basically to the pip. Here again, we're looking for patterns around these levels on the smaller time frame, not necessarily wanting to trade off the level. Okay, so very nice little reaction off there. Here again, when we get to patterns, there actually looks like there was a little pattern on the smaller time frame on the hourly chart, which will stand out, which is the head and shoulders, but we won't go into that right now. So I hope you find that helpful. Once again, we take the major swings that we identify, Fibonacci retracements from the very low to the very high. We then look for Fibonacci projections from the very high to the very low. Price retraces to at least the 38%. This one comes to the 618. We've got two areas, one with a 50, 127 horizontal support resistance, and then the next level down, 618, 1618. We have a refined area of support resistance here, and you can see we get a nice reaction. Here again, we're not looking to necessarily pinpoint the exact turning point. Remember, these are zones as discussed before, so we're looking for patterns around these levels. We also look to limit our risk. Hope you find that helpful.